You've felt it, haven't you? That feeling every year when the dollar in your pocket feels just a little bit weaker. That raise you worked so hard for. It feels like inflation ate it for lunch. And your savings? They're fighting a losing battle just to keep up. The official story is that this is just the natural ebb and flow of the market. They call it price stability. But that narrative is a lie. The truth is dictated by a forgotten, ironclad economic law, a sinister principle that explains exactly why your purchasing power is being systematically drained. What if I told you that the disappearance of good money, currency that actually holds its value, is in an accident? What if it's the engineered outcome of a process designed by the world's most powerful financial institutions? This isn't just about inflation. This is about the forgotten law that reveals how bad assets are perpetually forced into our financial bloodstream, poisoning your wealth from the inside out. This hidden history is the key to understanding why you are constantly fighting just to stay ahead. Before we unlock this mechanism, take a second. Where are you watching this unfiltered truth from? Drop your city in the comments below. And if you're ready to see the mechanism that truly runs your life, hit that subscribe button now. The historical setup is simple, brutal, and ancient. For centuries, currency was metallic. In 16th century England, people used both pure gold coins and debased coins that had been clipped by thieves or even the government. Sir Thomas Gresham, an English financier, observed a stunning phenomenon. People always hoarded the good, heavy, pure gold coins and rushed to spend the bad, lighter, debased coins. The good money vanished from circulation, and the bad money, the compromised currency, flooded the market. This became known as Gresham's law. Bad money drives out good. This law was a spontaneous market reaction to currency debasement and a lack of trust. Now, for our first shocking parallel. In historical England, the crown would secretly shave silver from coins to fund its wars. They were diluting the currency and transferring the cost of war directly to the citizens through hidden inflation. Sound familiar? Today, the central bank funds massive government deficits not by shaving metal, but by digitally creating money out of thin air. They call it quantitative easing, to buy government debt. They debase the fiat currency, transferring the cost of fiscal irresponsibility directly to your savings account. This problem persisted for centuries. The moment a government introduced a coin of lower intrinsic value alongside one of higher value, the more valuable coin would immediately disappear from daily use. Now, fast forward to the 2008 financial crisis. The system wasn't flooded with debased gold, but with something far more toxic: mortgage-backed securities and CDOs. These were the bad money of the modern era. The good money was the sound, reliable capital held by institutions and the public. And here's our second shocking parallel. In 2008, every major financial institution was desperate to dump their bad money, those toxic mortgage securities, before their true, worthless value became known to everyone. This market panic was effectively a modern, digital bank run. So what happened to all those toxic assets? Did they just vanish? No. They were driven out of the private sector and into the hands of the ultimate buyer of last resort. This isn't just similar to Gresham's law, it's the weaponization of it. The Federal Reserve stepped in with mechanisms designed not to fix the economy, but to force the system to accept the bad money. They created the illusion that these toxic securities still had value, preventing a total market collapse, but they had to use a secret mechanism to make it all work. The critical distinction is this. In the 16th century, the market spontaneously chose good over bad. In the 21st century, the financial elite engineered a mechanism to compel the public system to accept the bad money from the private sector. The law of good money disappearing was rewritten by the bankers. The key mechanism, the structural guarantee that enabled this entire scheme, involved an obscure, highly technical provision of the Federal Reserve Act. This provision allows the Fed to execute asset swaps and quantitative easing, specifically targeting toxic private sector debt. This mechanism centers on the power of the Federal Open Market Committee, which has private banking interests structurally embedded in its operations. The true financial alchemists are not the private banks themselves, but the mechanism they created to shift their moral hazard onto the public. The secret decision that truly activated modern Gresham's law was the Fed's authorization to use emergency liquidity tools to buy non-government assets, specifically the toxic mortgage-backed securities from the private banks. This wasn't merely lending. It was buying up the bad money that the private banks didn't want. The Fed, acting as the ultimate absorber of last resort, used its balance sheet to make the private sector whole again. But the price of this rescue was paid in the very currency that backs the entire system. The most powerful figure behind the decision to massively expand the Fed's balance sheet to include these toxic assets was a lifelong advocate of banking expansion, a man who viewed the central bank as the structural guarantor of private finance. You won't believe the name of the figure who oversaw this historic, structural transfer of risk and how much wilder the receipt is than you think. Let us delve into the weaponized mechanism of modern Gresham's law, central bank asset swaps, and quantitative easing, or QE. The core principle is simple. The financial system needed to get rid of its toxic, low-quality assets, the bad money, which were threatening to sink the private banks. The only entity large enough to absorb them was the Federal Reserve, in other words, the public. The mechanism works in a four-step process. First, the creation of bad money. Private banks engage in highly leveraged lending and create complex products like mortgage-backed securities to maximize short-term profit while creating massive, hidden risk. Second, systemic panic. The market eventually loses faith in this bad money, and the financial system faces insolvency. Liquidity dries up completely. Third, the swap. This is where the parasitic finance begins. The central bank steps in, initiating QE. The Fed digitally creates new, high-quality money, cleans central bank reserves, and uses it to buy the toxic, low-quality assets from the private banks. This is the asset swap. And finally, debasement. The toxic, bad money is moved onto the Fed's balance sheet, where the loss is socialized. The private banks receive clean capital in return. This vast influx of newly created money devalues the existing currency and erodes the public's purchasing power. The good money, sound capital, is effectively driven out. Here's a shocking statistic for you. In the aftermath of the 2008 crisis, the Federal Reserve acquired approximately $1.7 trillion in mortgage-backed securities through QE. They effectively socialized the risk that Wall Street's greed created. This isn't a spontaneous economic law. It's engineered collapse. The system is built to ensure that when private risk fails, it's automatically transferred to the public balance sheet, all disguised as monetary policy. And another one. Before 2008, the Fed's balance sheet was around $900 billion. Following QE, it exploded to over $4.5 trillion by 2015 and later approached a staggering $9 trillion. This exponential growth is a direct measure of the amount of private and government debt that has been monetized. It's the scale of the debasement. The moral hazard here is profound. Banks are incentivized to create the riskiest products possible, knowing the Fed will serve as their guaranteed buyer of last resort. They keep the profits, while the public absorbs the losses. Let this sink in. The U.S. dollar has lost over 97% of its purchasing power since the Federal Reserve was created in 1913. This statistic is the ultimate receipt of Gresham's law applied over a century. The continuous debasement of the currency to serve institutional stability. When the Fed abolished the reserve requirement for banks in 2020, it effectively unleashed the final constraint on the system. This was a structural guarantee that banks could lend infinitely against their reserves, knowing the Fed stood ready to backstop any resulting collapse through renewed QE. This move provided an unlimited license for greed. And for decades, the Federal Reserve paid its member commercial banks a guaranteed, risk-free dividend of 6% annually. This was a foundational subsidy, a gift from the public charter to private capital. The forgotten law is no longer about gold coins. It's about a financial system addicted to low-quality assets and unlimited liquidity, perpetually engineered to transfer private failure into public inflation. The forgotten law is now visible. It's not a conspiracy theory. It is a structural certainty built into the mechanics of the central bank. The Fed is the ultimate risk transfer vehicle, designed to absorb the moral hazard of its private bank owners and distribute the cost as generalized inflation to you. Today, the system operates faster and with less of a buffer than ever before. The abolition of the reserve requirement means the next crisis will be faster, bigger, and more difficult for the Fed to contain without printing an even larger, more destabilizing amount of money. We are operating on borrowed time. The historical lesson is that when private profit and public mandate collide, the public always pays the price. The solution begins not with protest, but with awareness. Stop trusting institutions built on self-preservation and start protecting your own purchasing power. Consider tangible assets, reduce your debt, and understand that inflation is a feature, not a bug, of this engineered system. We are required to deny that the system is structurally compromised, but the very debt that fuels the Fed's existence is the chain that binds the average person. So we must ask ourselves this question: are we wiser now, or are we just walking the same path in better suits? If you believe that history is not just the past, but an actionable blueprint for finance, share this video widely. Expose this hidden truth to your network. And subscribe immediately, so we can continue to unpack the hidden mechanisms that control your life and your wallet. Thank you for watching.